Stocks fell, bond yields rose. And in a market where those two things usually move in opposite directions, that combination is telling you something important. Global equity indexes declined broadly in recent sessions as military conflict in the Middle East, specifically involving Iran, rattled investors and raised fresh questions about where central banks go from here. The moves were sharp enough to force a reassessment across major markets. Here is why that bond market signal matters. In a typical sell-off, investors run toward the safety of government bonds. That demand pushes bond prices up and yields down. But that is not what happened here. Yields rose at the same time stocks fell. That pattern usually means inflation fear, not just plain fear, is doing the driving. And that distinction changes the calculus for central banks entirely. Iran is a major oil producer. It sits next to some of the most critical shipping lanes in the world, the Persian Gulf. When conflict flares in that region, energy markets feel it almost immediately. If oil prices climb and stay elevated, that feeds directly into consumer inflation. Higher gas prices, higher transport costs, higher prices across the board. That puts the world's major central banks in a genuinely difficult position. The US Federal Reserve has spent the past 2 years carefully trying to bring inflation back toward its 2% target. A sustained energy price shock could slow that progress, or push inflation back up, right when the Fed was beginning to see a clearer path forward. The European Central Bank and the Bank of England face similar pressure. Both have been managing their own delicate balance between cooling inflation and protecting growth. What markets are effectively pricing in now is more uncertainty, not a definitive shift in one direction, but a wider range of possible outcomes for interest rate decisions across major economies. There is a word for the scenario that worries policymakers most here: stagflation. That is when prices are rising and economic growth is slowing at the same time. It is one of the hardest environments for central banks to navigate because the tools they use to fight inflation, raising interest rates, can make a slowing economy worse. How serious this becomes depends on 3 things: how long the conflict lasts, how much it actually disrupts oil supply, and whether other major powers get drawn in. For now, markets are in wait-and-see mode. The signals that will matter most in the days ahead are energy prices and official communications from the Fed, the ECB, and the Bank of England. Watch what central bankers say, and watch what they do not say. In uncertain moments, silence from policymakers is a signal too. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.